Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. Hello and a warm welcome to the Open Treasury podcast. I am your host, Pushpendra Mehta. Joining me today are Jack Large, editor of CTMfile, and Ben Poole, writer at CTMfile. Welcome back, Jack and Ben. Let's delve deeper and get your viewpoint on our topics for today, namely faster and instant payments, faster fraud, Mastercard's AI solution helping UK banks fight real-time payment scams, an uptick in the rate of growth in the US services sector, China keen to expand BRICS membership, and the Federal Reserve Bank of New York's digital dollar research study deemed as successful. Our audience can read articles, interviews, and industry roundups by visiting CTMfile.com or by following the links in our show notes. Our first story for today is about faster and real-time payments that may result in a surge in payment fraud. The United States stands on the brink of a groundbreaking leap forward in the realm of payments and instant money movement, as FedNow, the US Federal Reserve's real-time payment system, is scheduled to launch later this month. Real-time payments are expected to make US domestic transactions and cross-border payments faster and more cost-effective than ever before. It will also mean enhanced visibility and control over cash flow. While all real-time payments can be categorized as a type of faster payments, not all faster payments are conducted in real time. Invariably, faster payments post and settle transactions faster than traditional payment methods, but they aren't all instantaneous. However, as the pace of the movement of funds increases, faster payments adoption is accelerating in countries around the globe, said an IT Novarica group report sponsored by Outsier. The report, titled Faster Payments, Faster Fraud, Solutions to Stop the Madness, surveyed fraud executives at major financial institutions in Brazil, Canada, India, the UK, and the US. Faster payment rails provide a great deal of utility to consumers and businesses alike, but what appeals to customers is nearly irresistible to fraudsters, observed the survey report. The adage, faster payments, faster fraud, is still unfortunately quite apropos. With payments innovation comes new opportunities to commit payment fraud, and faster payments have proven to be no exception. Thus, payment fraud remains a significant concern for treasury and finance professionals, with 2 out of 3 companies continuing to fall prey to fraudulent attacks as per the 2023 Association for Financial Professionals Payment Fraud and Control Survey. Fraud is a huge global problem, and losses on account of payment fraud worldwide exceeded US $32 billion in 2021, nearly $12 billion of which was in the US, according to the Nielsen report. Jack, faster and instant payments are here to stay, and so is real-time payment fraud. How can corporate treasury effectively address, in particular, faster and real-time payments fraud?
This is no surprise that we've had this problem for many years, and faster payments is just another example of the technology that delivers certainly services that the consumers particularly like. The issue for corporate treasurers is they're going to have to get more understanding and more protection at the technology level, as well as the procedures and mechanisms internally within the company. And it's the whole company. It's not just the corporate treasury department. I remember talking to a treasurer some years ago after he'd lost many millions in a fraud in the Far East. And he was saying the problem is you don't understand the level of knowledge required in your own company to really understand what is going on. Now, that is no longer an excuse. and they just have to up their game in all sorts of different ways. Fraud isn't going away. Real time isn't going away. Real time is where it's at. The problem is the technology inside a lot of corporates needs massive changes, as well as inside banks, to really cope with the consequences of real-time processing. I'm not sure how we're going to do it in one single jump. I think it's a continual pressure.
I absolutely agree with that, Jack. And, one of the things that came out of your story, Push, that you'd written, where you've pulled together all these really interesting findings that stood out to me is how these like money mule accounts are being used and how much of a huge problem they are for banks, let alone corporates. So, it's an issue that remains largely unsolved. And there's so many different types of money mules that have sort of different goals and they behave differently. Some of these will have opened an account deliberately to commit fraud themselves. Some will sell a genuine bank account to a fraudster. Others might execute a transaction because they believe that the money is clean. And then there's just the, victims of credential theft, who are unaware that their account has been used in that way. So there's lots of different plates spinning in that world. And, faster payments, if you can get the money into one account, then you can very quickly disperse it throughout several of these mule accounts. As Jack was saying as well, when it comes to treasurers, there are different approaches to try and mitigate the risk. Obviously, adopting technology is one way to go. There are real-time fraud prevention tools, such as transaction and insider threat behavior monitoring. And then again, as Jack was saying, education is critical, alerting staff to the type of threats they face. Now, that might be in the Treasury Department, and it could be Treasury educating some of the other parts of the business as well. And obviously speaking to banks and third-party technology providers about what they're doing to prevent these types of attack is something that treasurers can do as well. And just one side thought off this topic, open banking perhaps offers a way for a fraudster to connect with a bank in a way that wasn't possible before. So you really need to sort of quiz your banking partners about the steps they're taking as well as the steps that you're taking to kind of mitigate as much as possible this very real threat.
Yeah, I'd just like to add that the summation, I agree with all of what Ben said, but the summation of one report, because you've quoted several reports, the AATA Ricker group report, which says there's no single silver bullet. You've got to address all the different combinations. The biggest risk, actually, I think, is reputational risk. This is not understood in the consequences of reputational risk. All of a sudden, as we saw when one of the American banks went broke, is that all of a sudden people moved to the banks they were most confident in. And reputational risk, I think, is going to be probably the biggest consequence of this. It has to be managed on a huge scale.
Those are great points, Jack and Ben. If I may add my 2 cents, which revolves around training employees, specifically on payment fraud training. In other words, it may be a good idea for organizations to have ongoing and specific payment fraud training like securetreasury.com for their employees, which is distinct from general cybersecurity training. This will help in preventing and fighting payments fraud and reducing the impact of such losses in the world of faster and instant payments. Continuing with our discussion on fighting instant payment frauds, the second news item for today is about Mastercard leveraging AI to fight real-time payment scams. Mastercard is taking the fight to the fraudsters with its one-of-a-kind AI-powered consumer fraud risk solution now live in the United Kingdom. Mastercard, in partnership with 9 UK banks, including Lloyds Bank, Halifax, Bank of Scotland, NatWest, Monzo, and TSB, is using large-scale payments data or intelligence to help identify real-time payment scams before funds leave a victim's account. Ben, with fraudulent payments becoming ever more complex, is there any specific aspect or area within treasury management that you believe can benefit a great deal from Mastercard's AI-powered intelligence solution?
That's a great question, Push. And this story, finally some good news about AI in terms of some of the slightly dodgier headlines they've had recently. Well, I mean, this specific story is quite interesting. Obviously, this is really focused on consumer payments, so might not impact treasurers as much as maybe a B2B payments program of a similar style. What I thought was really interesting was in the report, it details the results of TSB since they've started using the solution. And then they've projected out that if all UK banks were using the solution, it could save around £100 million a year. So if that's just targeting consumer fraud, you can imagine how much that number might multiply if you applied it to corporate payment fraud, which very often are dealing in much, much bigger volumes in terms of transactions. I also thought the nugget about how the solution was particularly successful when combined with other insights about the customer and their usual behavior was very telling. And that really points to that part of the report that Jack just cited, in that there is no magic bullet to stopping fraud, and treasurers need a variety of different tactics and solutions in their toolbox to mitigate this fraud risk as much as possible. But I think any experiments like this with new technology and finding ways to smartly deploy it has got to be good news for the people that are trying to prevent the fraud that we talked about in the first story.
And this example of the use of AI by Mastercard is an important example of how fraud needs to track the whole range of the different parts of the transaction and the different accounts used. And AI is probably the only technology that can bring all of this together. My concern is that this is so complex, we're maybe not going to do it in time and we'll have further big risks. I think the message for large corporates is you need to tackle this sooner rather than later. New initiatives are needed now, not in a couple of years' time.
And I also thought it was interesting around sort of the maturity of different faster and instant payment systems. It's interesting that Mastercard have been trialing this technology in the UK, where we've had the faster payment system since 2008. And obviously in the first story, Push, you mentioned the launch of FedNow, which is coming this month. And obviously there's the RTP network from the clearinghouse, which was launched in 2017. So, if you look at the culture around faster payments, that's not quite as mature in the US, for example, as it is in the UK or elsewhere. So I really think that particularly with a tool like AI, you need as much data as possible. And that's where the UK is a really good place for trialing a solution like this. So whether something like this would work if you could drop it into a brand new instant payment system, I'm not sure, but it's certainly, a step in the right direction.
The need for understanding of past track records and experience with the whole system is what's essential here, because fraud doesn't start today. It starts months or maybe even years before. There's a plan how to do it and set up the technologies and get the passwords and the accounts in place. This is going to be endemic, I think, for a long while. I think corporate treasurers may actually have to do fraud control market by market rather than systems in general, but do Belgium differently from the Netherlands, differently from Vietnam, and so on. Each country is going to be different.
Yeah, because particularly with limits of payments that are allowed by different systems in the EU, I think there's largely a €100,000 limit in most countries, but not everywhere. The Netherlands doesn't have a limit in terms of how many euros you can transmit using the faster payment system in Europe. So, yeah, that's also something to keep an eye on.
Well, that's a fascinating analysis, Jack and Ben, and I hope our audience was paying particular attention to both your discerning perspectives. Let's move forward to the third topic in today's discussion, which is about an uptick in the rate of growth in the US services sector. Economic activity in the services sector expanded in June for the sixth consecutive month as the services PMI registered 53.9, say the nation's purchasing and supply executives in the latest services report on business from the Institute for Supply Management. A reading above 50 indicates growth in the services industry, which accounts for more than 2/3 of the US economy. The sector has grown in 36 of the last 37 months, with a lone contraction in December 2022. Jack, if you were a treasurer at a multinational corporation, how do you think would the sustained growth in the US services sector, as indicated by the latest PMI data, impact your treasury management strategies or decision making?
Enormously. The first point is that services is becoming the new growth area globally. We are starting to get beyond manufacturing and supplying of goods. Now it's the services supporting the different parts of this. Apple is a good example. And to do this successfully, companies are going to need to have financing mechanisms and systems to support the new services. And this is where corporate treasurers come in. They can open up whole new markets for their companies if they can find ways of financing new services that are inevitably needed from products and different range of solutions. Services is the future.
I definitely agree with that. And it's something that we've seen really strongly this year in a number of countries is when you look at the composite PMI, which is the manufacturing and the services, a lot of countries, their composite will be 50 and over, but it's really the services score that is dragging manufacturing up to that line and across it. So that's a great point from Jack there. And in this specific case, obviously this score is just for 1 month, but as you alluded to, Push, it's quite remarkable that in the past 3 years, they've only had 1 month of contraction, particularly when you consider like some of the events we've been through since 2020. That's really incredible. So the strong activity in the US economy, does suggest that perhaps the Fed's aggressive rate hikes of the past year haven't, squashed growth. So that's really encouraging. Again, this is just one data point, and it will take a lot more positive economic news like this to shift Fed rate policy. The last meeting, the Fed did pause its hiking of interest rates, of course, but Chair Jerome Powell did note in the July's monetary policy meeting will be live for a potential hike, and also clarified that the pause was a continuation of moderating the pace of hikes. So if I were a treasurer with US interests, no pun intended, I wouldn't be betting on rate cuts just yet. The hiking cycle has cooled somewhat, but it's certainly not stopped.
Jack made a very powerful statement in terms of the services being the future of the major economies of the world. And, to your point, Ben, there may be another rate hike in July, something that we need to watch extremely carefully. And I couldn't agree with you more. The next story that warrants discussion revolves around the 5 developing economies dubbed the BRICS: Brazil, Russia, India, China, and South Africa, brainstorming on the group's possible expansion ahead of their summit meeting in August. When the 5 BRICS members gather for the leadership summit next month in Johannesburg in South Africa, frontrunners to join the bloc will include Argentina, Egypt, Indonesia, the UAE, Saudi Arabia, Algeria, Bangladesh, and Iran. While China is seeking to expand its sphere of influence by inviting its allied or friendly countries into the family of BRICS, India is particularly wary of the plan and doesn't want to lose influence in the bloc. India is concerned that a BRICS expansion consisting of China's friendly nations would grow China's economic and political influence. BRICS countries account for more than 40% of the world's population and about 26% of the global economy. Jack, if China is able to succeed in its BRICS membership expansion plan, do you think in the medium to long term, BRICS will present a credible economic and political counterweight to Western dominance?
I'm afraid I have problem with BRICS. The driver is obviously China, but China has been working at this for the last 2 decades. They've invested in countries like Ethiopia, which was one of the other countries wanting to join BRICS, has started to say, okay, now we've invested in you, now you need to support us. This is a long-term political game as far as China is concerned. If I was any of the other BRICS members like in India and Brazil, I'd be very wary of this. The problem for corporate treasurers is I'm not sure how they can influence this at all. The issue is going to be beyond their scope in some ways. However, having said that, the assessment of the impact of extending the membership, I think, needs to be examined by corporate treasurers and advising their board as to what they think the consequences are, because I think it'll have an impact on both the foreign exchange rates, but also the interest rates in the individual countries. This is big stuff. Trouble is, it's played at China level rather than corporate level.
Yeah, it's definitely something to add to the macro risk pile that treasurers are handling. And in the report, the idea of a qualification criteria is brought up. I think it's India that was pushing for that. And I find that idea absolutely fascinating in terms of what that would entail. You know, once a country meets the criteria, is it immediately into the trading bloc? Can you fall out of eligibility? How would the current members fare against such a criteria? You know, would widespread global economic sanctions knock you out of contention, for example? Mentioning no names. They've certainly got a lot to discuss in Johannesburg in August. And it's really fascinating to just look at, you can kind of understand both countries' points in China and India and where they want to go, but they are pointing in slightly different directions at the moment. So whether they can hammer out some sort of agreement next month is something to keep a close eye on. Yeah,
the other statistic that you quoted was saying 40% of the world's population are in the BRICS countries, but they've only got 26% of the economy turnover in terms of revenues. This defines the problem in a way that we've got, is that there's an imbalance between the West and the BRICS countries. I think this tension is going to just keep going. There isn't an easy solution. I would just be cautious.
That's great advice, to stay cautious. Our next news item, which is the fifth story for today, is about the Federal Reserve Bank of New York's successful digital dollar research study. The Federal Reserve Bank of New York's New York Innovation Center, in collaboration with members of the U.S. financial services sector, published the findings of a proof of concept, or POC, that explored the feasibility of an interoperable network for wholesale payments operating on a shared multi-entity distributed ledger. This proof of concept, or POC, explored the feasibility of distributed ledger technology in support of safe and efficient payments. The POC experimented with domestic interbank payments and cross-border payments in the US. For domestic interbank payments, the use case simulated US dollar wholesale payments between commercial banks and was intended to prove the core functionality of the theoretical payment system. Transactions were conducted in commercial bank deposit tokens and settled using a theoretical wholesale central bank digital currency, a tokenized record of a central bank deposit liability. For cross-border payments in US dollars, the use case focused on cross-border US dollar wholesale payments and explored the potential of the concept to enhance the experience of global users of US dollar as an international trade and settlement currency. Ben, from a corporate treasury perspective, what is your opinion about the New York Federal Reserve's proof of concept run?
Thanks, Push. Yeah, it's, I think, just another sign that CBDCs are getting closer and closer. It's a really interesting group that came together for this particular study. So, like you said, you've got the Federal Reserve Bank of New York's New York Innovation Center. You've got major banks. You've got SWIFT. who you could say are the incumbent transaction network. And then you've also got Settle, who offer the regulated liability network, ledger framework. So 3 or 4 different areas of the financial world all coming together on this project. And that's the sort of partnership and interoperability that will be vital to take CBDCs to the next stage. I thought it was quite interesting how they'd split the study into 3 work streams, into technical, business, and legal. A couple of things that just stood out to me was that the technical work stream found that in theory, having a wholesale CBDC and commercial bank deposit tokens on the same platform would enable a shared ledger to settle payment transactions simultaneously and in near real time. And also the legal work stream found there were no insuperable legal impediments under existing US legal frameworks that would prevent establishing a regulated liability network system as contemplated in this proof of concept. So yeah, for treasurers, it's just a sign that get ready for central bank digital currencies. We talk a lot about digitalizing various areas of treasury. And I think putting in that work today, we'll see treasurers on a better footing when it comes to contemplating how CBDCs will impact their way of working as we slowly draw closer to that reality of major currencies having a digital form.
I too was picked out the fact that they'd split it into technical, business and legal. This is undoubtedly the framework for analysis. The thing that really worries me is that we're starting to get a merger between single payments and real-time payments, and you're starting to see them trying to merge the two together. And I'm not at all sure that digital currencies are going to work quite like this, because the framework, the technology is not made for real-time payments, my understanding, unless they've got a new nano computer working that really can do this instantaneously. I don't think, again, as a corporate treasurer, you've got much choice here. The issue is, yes, the people are being sensible, but how is it going to be imposed? How is it going to affect my company specifically? Do I have to use all of it or just some of it? Can I pick and choose? These are things that are starting to emerge for me as the real questions behind this very lucid framework and good analysis, but the consequences are not discussed almost at all.
Yeah, it's almost like, can we do it rather than should we do it?
Exactly right. And corporate treasury is all about doing it and having to do it, and it has to work, it has to make sense. I have to report to the board who are going to be very nervous if you've got hundreds and maybe millions and maybe billions value tied up in something that the board doesn't really understand, let alone the corporate treasurer.
Finally, gentlemen, what is your choice for the biggest, the most important story of the past week, and why? Jack, would you like to do the honors first?
Yes, I think the 5 items that we've covered just stress yet again the scale and breadth of what corporate treasury covers. They're not only being asked to do mundane day-to-day in real time, but also setting up new frameworks to open up new businesses. The responsibility of treasury is growing all the time, is my take from the last 5 items.
Yeah, I'd highlight the digital dollar story and maybe link it back to the earlier payment fraud topic and just look at how potentially, the technology that's involved there might play a role in helping to mitigate fraud. Obviously, distributed ledger networks will never eliminate 100% of fraud, but in theory, they can definitely reduce it significantly with areas such as digital identity verification that will have to become much better for platforms like that to exist. And having that open view of information about transactions and items in the network should make fraud and errors easier to detect. I say should because, of course, fraudsters will already be investing time and money into finding ways to attack networks like this or network users. but it offers a bit more hope potentially in the fight against fraud.
Jack and Ben, let me express my deepest gratitude to you for your participation and for enriching today's conversation. We would also like to thank in abundance our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.